Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap that we do here each and every night on the membership side of our blog. So we had a little bit more of an active day today, still a lot of working orders trying to get into the market, but it's been a really interesting market just today opening up. We opened up to the downside, then we rallied back up, and then we kind of fell off towards the end of the afternoon. So a lot of indecision here at the end of the market closing out today, and just a lot going on in the world and with earnings still happening. We've definitely got a lot of activity to go before we start seeing some clear direction in the market. Today we had 2 or 3 opening trades, and 2 I want to go over with in more detail than the first one, CVS, which is pretty standard debit spread. And then we had 1 closing trade. So I'm actually going to start with the closing trade in DIA, which is the diamonds. So we originally had a debit put spread in the diamonds, the 163, 159. And today we are actually up about $30 on it and bought it back for a loss at a 67 credit or 113 loss per spread. Now this was originally a addition to our portfolio to add some negative deltas. So as the market was heading lower, we tried to add this to get some negative delta in our portfolio. But this is one of those positions where I definitely want to quickly show you guys why we didn't roll this contract. Because I got a lot of people saying, well, Kirk, why didn't you roll that contract to the next month and just extend out the trade and see if we can't get some good movement? And while I still think that the market maybe is a little top heavy in the diamonds and could definitely move lower, as the market continued to rally today, it was really clear that we're not going to get down to 63, at least for our first strike, and then 59 is our short strike. So our break-even price is much below 63. So we really need to get down to about 61.5 or so to actually start to make some money at expiration, which is a pretty good move in the next couple of days for the market to make, especially the diamonds, which move a little bit slower. So, but we did look at rolling the trade. I want to show you guys what that looks like and what the kind of thought process is behind that. So let me see if I can bring up this order. Okay, so all I did here was just make a sample order below. And if we were to roll, we would roll these contracts, these May, out to the June expiration. So we're looking at June expiration on our chart. And you'll see that I've just kind of highlighted this 163 strike and the 159 strike right down here below in the order so that you guys can see what that would possibly look like. So to roll a contract, we would actually have to close out of our current month, which we already did, and then re-enter the trade on the new month for new pricing. So consider it 2 separate trades, right? We close out this month and pay $67 or get $67 in credit. But then we would have to go back out to the market and pay $99 as a debit. So the net price is that we would actually have to pay about $23 or so to roll the contract to next month. And that really doesn't make sense in our mind. So paying to roll a spread really doesn't make sense unless we got this spread originally very cheap. So by paying to roll, we're doing ourselves no good service at all. We're just adding to the additional loss and possibly extending the loss even further. So at this point, the smarter trade decision is to actually just close out the contract, take the loss, and if you're still bearish on the DIA or the diamonds, then to reset your strikes back up to where the current market is and move forward. All right, so the first opening order that we had here today was CVS. This is a pretty vanilla trade for us. We opened a debit call spread, the 72.5, 77.5 call spread. We paid a little over mid price at 265. We like to get these spreads around 250 or so, but again, the name of the game here is just adding a little bit more positive delta to our portfolio. CVS had a really good last couple of days and continues to move higher, so we're kind of buying the breakout here. Implied volatility is still low, so we're playing a little bit of implied volatility, but really just buying the breakout here and hoping that over the next month and a half that the stock will at least just kind of float or trend higher. It's been doing a really good job this year, except for kind of the beginning of December and January. But the stock has really been kind of resilient even in the face of the recent market turmoil. So if the general market turns higher, I think CVS will definitely go with it. All right, so let's get down into Pfizer and YHOO. So Pfizer is an opening trade because the stock actually had earnings today and kind of gapped lower towards our current debit, our current put spread that we have on Pfizer. So we currently have the 30.29 credit put spread that we had originally entered on Friday, so it was kind of only one day into this trade. But as Pfizer gapped lower, implied volatility still stayed fairly high when we actually entered this trade. And so what we did is, like we always do with a lot of these trades around earnings, is that if it kind of tests our lower side and tests our strikes, we're going to go back in there and we're going to sell a call spread against it for the same width of strikes. So you see it's the same dollar wide strikes that we had below and the same number of contracts. So we had originally sold 7 of the credit put spreads. So we went back in and sold 7 more of the call spreads on the other side of the market. And by doing this, we took in a nice credit of about 20 cents, which is actually a pretty hefty credit. And we did this with no extra risk. So by doing this, all we are doing is reducing our possible loss, possibly increasing our potential for profit here, and all of this at no additional risk. So that's the key here, is that if you match up the strike prices and match up the number of contracts, i.e. 7, then you do this with no additional risk to your overall portfolio. So you can see that Pfizer gapped lower. It's actually still in a range where if it expired right here, we'd actually make money on the whole thing. But you can see it really is testing our lower strike at 30 by being just slightly in the money, a couple cents. So what we did is we went in and sold the 31, bought the 32 up here for a 20-cent credit. So we've kind of got this window between around 30 and 31 that we want Pfizer to close in between now and May expiration. So a nice little rally after earnings would obviously help. You can see that Pfizer's been very, very active in the last couple of months. So I don't kind of see this thing as out of the question that it could rally up very quickly and we could see a profit and be out of this position. As you'll notice, even after earnings, implied volatility is still very high, which is kind of rare for a stock like this to see implied volatility continue to be high after earnings. So it gives us a good opportunity to make a trade. Now, if we actually look at the Analyze tab here, and I'll type in Pfizer on our Thinkorswim chart, basically what we have here is a very wide iron condor. So you can see where Pfizer is now at 29, basically 30 right here in the middle of our condor. Our break-even price is actually closer to about 29.40 or so. I think that's where it's at, or I think that's where it's sitting. It's around 29.40. Yep, about 29.45 or so is where our break-even price is. So we actually have some room to the downside before we actually hit our break-even price and start to lose money on this trade at expiration. So we are giving ourselves a little bit of room, but you see by managing our trade and by adding a current position on the top side, that's the same width and strikes and also the same number of contracts, we are not increasing our overall risk from our original position. If anything, we're decreasing our risk, decreasing our possible loss, and actually increasing the probability that we make some money on this trade. So I wanted to show you guys this because this is really how you should effectively manage some credit spreads around earnings and going forward. The other trade that we did today, and this one's a little bit custom, and that's why I sent out the order that was custom and had a little note attached to this trade order. But we actually bought a pretty unique spread in YHOO, and I haven't done one of these in a while, and just felt like it was a really good setup in YHOO going forward. It still has very high implied volatility. Now I'll note that this is not for everybody because this is effectively a naked position where we have an unlimited risk to the upside. This is going to be a trade where you may not be able to execute it in your trading account because you need a certain level of trading authority with your brokerage. So you might need like a level 3 or 4 or whatever the case is. But let me just explain what this strategy is. So what we're doing here is doing 2 strategies basically. We have a long debit spread of a 36.37 call. So you can see we basically bought the 36.37 call spread in YHOO. Now you're probably wondering, Kirk, why are you buying a call spread in YHOO? It's got high implied volatility. You don't ever want to be buying spreads in YHOO. Well, that isn't the whole strategy, but it is one part, and that's the way that I break it down in my mind and the way I teach people to break it down, is to buy the 36.37 call spread. Now that's a dollar-wide spread, and that basically costs us around 46-45 cents to buy that spread, which is still around mid-price where we usually want to buy a spread. Now on top of that, we went out in the market, further up in the call section, and we sold a 42 strike call for a little over the cost that it cost us to buy that spread, that 36.37. So again, the 36.37 cost us around 45 cents. We went up to the 42 calls. We sold a naked call equal to the number of spreads that we bought, and that credit that we received was around 46 cents. So overall, we got a $1 credit, right? Woohoo. I mean, it doesn't really cover commissions, but we did get a credit on this trade before commissions. And so what we did here is by covering this entire width of the strikes, so basically financing this premium here, this purchase here, with the sale of the 42 calls, we basically move our break-even point out one whole dollar out to 43. And so I'll visually show you guys this on the trade tab as well and on the analyze tab. But just logically thinking about it, because we covered the entire cost of this spread, we have now moved our break-even point out to 43. So what we effectively have is a position where Yahoo can go as high as it wants up to 43, and we make money, giving ourselves a huge range to make money on the top side with effectively no risk to the downside, right? So this is a very, very good way to get involved in naked option selling without taking some immediate risk in the market. So let's take a look at where Yahoo is, and I want to show you guys the actual trades first before we go into the Analyze tab and to the chart. So I'll get rid of these orders and show you guys our custom order. Okay, so here we are inside the June options, and you see that our trade tab is right here below. Now our custom order has, again, we bought 136 and we sold a 37. So those two together basically create our debit call spread. And then we went out and sold a 42 call against that whole position. So you see we have a position right around the market at 36.37, and then we went all the way out and sold a 42 strike call to help finance that purchase of the 36.37. By doing all of this, we took in a net credit of $1. So we actually want the spread, since it was a buy order, even though we took in a credit, we actually want the spread to go up in value and sell it later on for a higher price than what we have now. Now, if we actually go to the Analyze tab so you guys can see what this looks like, and we'll get out of Pfizer, this is what the actual position looks like for Yahoo. And you can see it's a little bit different than what you're used to. It looks like a call spread all the way until you get to that short strike at 42. So you can see at 36 it pivots, just like a normal call spread does at 36 and 37. This is the range that we actually make money in right here. And then as it gets to 42, it starts to head down until it crosses our break-even point right here at 43. So that's the point at which we actually lose money at expiration, is at 43. So this gives us a nice window of opportunity here to make money in Yahoo by the stock either falling just slightly from where it is now. It's at 36.97. Can actually fall down to around 36 and actually can go all the way to zero basically, and we have effectively no risk except for the cost to get into the trade, which is like 10-15 bucks. But we really want Pfizer to trade anywhere above where it is now, between here and basically 42 by expiration, and then we make some good money on this trade. So you can see it's a little bit different strategy, but it gives us a very, very wide window of opportunity to make money. And when you see the chart of Yahoo, you can see just how wide this window is. So basically anywhere from 37 to 42 is where we want the stock to trade between now and expiration, and kind of close in that window. So if we go to Yahoo, now we kind of pull this all thing together and we see the big window that we have of opportunity between Yahoo. We basically have this massive window all the way up to a strike price of 42. This is kind of the money window for us. We want Yahoo to trade inside that window between now and expiration. Again, we have virtually no risk to the downside because we did this thing for a small credit, right? So Yahoo can actually crash, and we're okay with this position. And if Yahoo rallies, then we'll close it out before it even gets close to the 42 strike that we're naked. So a lot of people will say, well, Kirk, well, this is a naked option. I don't like trading naked options. But look, you have a huge opportunity to make money before it even gets to your strike price at 42, where you could potentially start to lose money. So at the end of the day, this is going to be a really, really good trade. It's a very good risk-reward trade. We're taking very, very small risk for a big potential payout here. I really like this trade. I'm going to try to actually make a couple more of these trades. I have another working order for another stock to make this trade, but it all hinges on the fact that implied volatility is still high, and that's because we are net selling options. Even though we bought a call spread, our net total is that we're short 2 calls and long 1 call. So we're still an option seller here, which is only why this works during high implied volatility times like we have now. And again, no earnings on the horizon for Yahoo. So this is a really, really unique trade, something that you really don't get an opportunity to do, and we thought that it was going to be really good to show it tonight in the video. So if you have any questions about this one, I know this one caused a lot of questions. People don't see this type of trade that often, but hopefully this video really clears the air on what we're doing with this strategy for Yahoo going forward. So I think this is going to be a really good trade. As always, if you have any questions or comments, please add them right below to the comment section. I'll get back to all of those either tonight or tomorrow before the market open, and happy trading.